What's up, ladies and gentlemen? Today's video is going to be a complete introduction to the stock market for all the beginner investors out there. I'll be covering everything from what is a stock, what is the stock market, how you could go ahead and buy stocks, what makes a stock price go up and down, how you could make money investing in stocks, how you could lose money investing in stocks, the three main different investing strategies, my favorite investing strategy, and why. And I also briefly touch on other things that I believe are important along the way, and at the end of the video, I touch on my two favorite investing strategies. The first one is very easy and very simple to follow. Anybody can do it, and it could make you a lot of money over the long term. And the second one is the investing strategy that I personally follow, which is harder to be successful at, but I believe with enough time and dedication, everybody can learn to be successful at it. And this investing strategy can make you a crazy amount of money over the long term. But I'd just like to acknowledge there's a ton of information in this video, and by the end of it, you're going to learn a ton of valuable information for your stock market investing journey. But to learn everything there is to know about the stock market will take you years. So just be patient with yourself and constantly keep asking questions. And if you have any questions after this video, feel free to leave a question in the comment section, or you can message me on Instagram at AbuTheInvestor. I try to reply to as many people's questions as possible, and I also post stock market content on TikTok, and you can follow me there at Dailystocktalk. But before we get into this video, I'd just like to let you know, soon I'll be posting in-depth analysis on all of my favorite stock picks and all of my favorite companies to invest in. So if you haven't subscribed to the channel already, go ahead and hit that subscribe button, and if you do gain value from this video, hit that like button and leave me a comment in the comment section, as it really does help the YouTube channel. But first, I do have to mention I'm not a financial advisor. I'm just a random person on the internet that has seen success investing in the stock market and that has a passion to teach other people stock market investing. And because of all the success I've seen, I've just created this YouTube channel to document my journey. So you guys will be seeing everything that I do invest in. You'll be seeing all of my gains, all of my losses. And currently my stock market investing portfolio is up over 115%. But the point of this channel isn't only to document my journey, but I truly believe people can learn a lot from my experience, meaning all of my success and all of my mistakes. But that's it for the intro, guys. Let's get right into the video. So what is a stock? When you purchase a company stock, you're making an equity investment in that company. Equity is just another word for ownership. So you're making an ownership investment in that company, and you're essentially becoming a part owner of that company. But in stock market terms, you're considered a shareholder. So when you purchase shares of Apple stock, for an example, you're becoming a part owner of the company Apple. This big number here is known as the market price. This is what it would cost you to purchase one share of Apple stock right now at this moment. So if you were to purchase one share of Apple stock, it would cost you $425.04. If you wanted to purchase two shares of Apple stock, it would cost you $425.04 times 2. If you wanted to purchase 10 shares, it would cost you the share price times 10. But Apple is a massive company, and as of Friday, July 31st, Apple became the most valuable company in the world. So if you look here at the market cap, the company Apple is valued at $1.84 trillion. So if we divide the market cap of $1.84 trillion by the share price of $425, we'll find out that there's about 4.3 billion shares of Apple stock available. So if you were to purchase all 4.3 billion shares of Apple stock, you would be pretty much buying out the entire company. But if you purchase 2.15 billion shares, which would be half the company shares, you would be owner of half the company. But even if you were to purchase just one share of Apple stock, you would still be considered a part owner of the company, along with millions of other shareholders. But the percentage of the company you would own would just be very, very small. But you're still considered a part owner / shareholder of the company. And the more shares that you purchase, the more ownership of the company you have. And to avoid any confusion, it's important that I mention this. So here today, Apple has announced a 4-for-1 stock split to bring in new investors. All this means is that if you're watching this video after August 31st, Apple's stock price might be 4 times cheaper. So what Apple is doing is that they're basically creating 4 times more shares. So if you own one Apple share here today, on August 31st, you're going to own 4 Apple shares that are 4 times cheaper. So for example, instead of owning one share that's $400, you're going to own 4 shares that are $100. And if you don't own any Apple shares, you'll be able to purchase one share for 4 times cheaper. But that one share or one slice of the company you would be purchasing would be a much smaller slice of the entire company. So what this does is that it makes shares more affordable for all investors by creating 4 times more shares available. So the total value of all shares, or the market cap, will stay the same, but the share price for one share will go down. And if that didn't make sense, here's another example, because this is something that's very important. So a frequently asked question that I get is that if Apple stock is the most valuable company in the world, why is Tesla stock trading at $1,400 a share? So like I mentioned, this is just the price of one share, but the market cap is the total value of all shares. So all the shares of Tesla right now are valued at $266 billion. All this means is that there's less shares available of Tesla. If we divide the market cap of $266 billion by the share price of $1,400, we'll find out that Tesla only has 190 million shares available. So if you'd like to know what investors are valuing the entire company at any given moment, or what company is worth more at any given moment, you must look at the market cap. And the market cap will go up if the share price goes up, and the market cap will go down if the share price goes down. Because like I said, the market cap is the total value of all shares. There are thousands of companies that you could invest in, and here are just a few as an example. And if you're thinking, man, I don't have hundreds or thousands of dollars to invest right now, that's okay, because there's company stocks out there that you could invest in with less than $20 to your name. For example, we have Ford stock, which is trading at $6.60 a share. Then we have Snapchat, which is trading at $22.42 a share. And there's also the company NIO, which is considered Tesla's #1 competitor in China. And their stock is trading at less than $12 a share. And if you invested in this company 1 year ago, your investment's value would have went up 4 times. But I'll explain how all of that works later on in the video. But what is the stock market? So the stock market is basically the marketplace where investors buy and sell company shares. So companies that you can invest in through the stock market are known as publicly traded companies. This just means that they're companies that anybody in the public can invest in. Whereas IKEA, for example, is a privately owned company. So only private investors have the opportunity to invest in a company like IKEA. But when companies decide to list their shares on a stock exchange, this is because they could potentially raise a lot more money a lot faster from the public markets than from private investors. And this allows them to expand their business much faster. In the past, investors were given paper share certificates that represented how many shares of the company they owned. And in order to buy and sell shares, investors would have to meet up in person to make a trade. But here today, everything is done online, and the stock market is digital. And it doesn't matter where you are in the world, you could invest in the stock market and buy and sell shares within milliseconds from a computer, laptop, tablet, or your smartphone. You could literally be on the beach somewhere across the world and invest in the stock market. So in order to actually invest in stocks, you need what is called an online broker. Here are some examples of some Canadian online brokers, and here are some examples of some American online brokers. So if you're from the States, you guys have a $0 commission fee for every single online broker there is. But as you can see, the Canadian brokers charge a commission, and these commissions range from $5 to $10 a trade. And there's potentially other requirements you need before opening this account. So for example, the first online broker I signed up with was TD Webbroker. And every single time I place a buy order or a sell order on company stocks, I get charged $10 commission. So basically for Canadians, we're paying these online brokers a commission every single time we buy or sell company shares. So every time I buy or sell shares through TD Webbroker, I pay a $10 commission. So this really sucks if you're only investing a few dollars or a few $100s at a time, as a $10 commission every single time you buy or sell shares could really put a dent in your profits over the long term. So although I do still use TD Webbroker for a lot of my investments, because it does have its benefits, I also use Wealthsimple, as it's Canada's first commission-free trading platform. It's extremely easy to use and understand, and it's what I recommend to all beginner investors. One of the downsides is that it doesn't have every single stock like TD Webbroker, but it does have pretty much every big company stock that you're already aware of, and there's no minimum requirements for how much you're going to invest. And the fact that you're paying $0 in commissions can save you a lot of money over the long term. So of course there's many different options that you could choose from, and Americans don't have the same problem because every single online broker is basically commission free. But personally, I truly believe Wealthsimple is the best option for beginner investors in Canada, as the $0 commissions will save you a lot of money, and it's really a good way to test the waters to see if you're really interested in stock market investing. And if you do decide to sign up for Wealthsimple, I'm going to leave my referral link in the description, and if you invest just $100 within the next 2 months, we both get $10 free to invest. I could make a step-by-step tutorial on how to buy stocks if you guys would like, but basically you sign up with an online broker, you give them your information like you would a bank, you transfer money from your bank account to your investing account, you search up a company stock, you choose how many shares you want to buy, and you place your order by hitting the buy button. And it's the same thing when you would like to sell your shares. You choose how many shares you'd like to sell, and you hit sell. Now, how do you actually make and lose money investing in the stock market? So if we look at Apple stock, we could see here on June 25th, 2010, which is shortly after the first iPhone came out, Apple stock was trading at $38 a share. So for every share that we purchased on June 25th, 2010, we would have paid $38 a share. And for every share that we purchased, they would be worth $425 here today, which is $386 profit per share, or a 1,000% return on investment. So a 1,000% return on investment means every $100 invested would be $1,000 here today. Or for every $1,000 invested, that would be $10,000 here today. But you don't actually make money on a stock until you sell it for a profit. And you don't actually lose money on a stock until you sell it at a loss. And let me show you an example. 1 year ago today, you would have been able to buy one share of Apple stock for $193.34. But here today, those same shares would be worth $231 more, meaning you would have more than doubled your investment. But let's say you bought shares of Apple stock on February 12, 2020 for $327 a share. Just over 1 month later, those same shares dropped 31% in value, dropping $102 per share. And if you sold those shares when they hit $224, then you would have sold your investment at a 30% loss, and you would have lost $100 per share. But let's say you didn't sell your shares when they dropped, and you held on to those shares because you believed in the company Apple, and you believed the share price would still continue to rise over time. Well, looking back, it looks like you were right. And the shares that you still held on to are now up 30% in value, and you're up $97 per share. But just to summarize, you don't actually make money on a stock until you sell it for a higher price than what you bought it at. And you don't actually lose money on a stock until you decide to sell it for a lower price than what you bought it at. So now you're probably wondering what makes the stock price go up and what makes the stock price go down. So at the end of the day, stock prices go up and down based off of supply and demand. So you want to think of more demand for a company stock as more buyers, and you want to think of more supply of a company stock as more sellers. So on any given day, if there's more buyers than sellers on a company stock, the price will get bid higher and higher. And if there's more sellers or more supply of a company stock on a given day, then the price will get bid lower and lower. And when the stock market is open, people are buying and selling shares every single second. But within that second, if there's more shares being bought, the stock price will slowly go higher. And within that second, if more shares are being sold, then the stock price will start to go lower. What affects a company's stock price in the short term is new information. So when positive news comes out around a company, this may cause demand for a company's shares to rise. But when bad news comes out around a company, this may cause investors to want to sell their shares rather than investors looking to buy shares, meaning there's more supply than demand in the market, causing the share price to go down. But over the long term, what affects the company's stock price is how much money they're able to make. And this is why the most important piece of information that comes out around a company is their financial reports. So every 3 months, every single company that's listed on the stock market must release their financials. So they must report how much money they've made and how much money they've lost. And these financials is what investors look at to determine whether they're getting a good or bad deal on the company stock. But the news and developments around a company are also important, because while many investors are investing in companies based on how much money they make today, there are also investors like myself that invest in companies based on how much we believe they'll make in the future. Like I said earlier in the video, if you invested in Apple stock in 2010, you would have made an over 1000% return on investment, which is over a 10 times return on your money. But along the way, there was many dips in the company's stock price of over 20%, as you could see here. From June 5th, 2015 to May 13th, 2016, Apple stock fell nearly 30%. And this article came out on April 29th, 2016. And as you could see, Apple stock suffered their worst week in 3 years at the time. And this was because investors were worried about a slowdown in iPhone sales. And also it looks like an influential shareholder revealed that he sold all of his shares. Apple posted their first ever quarterly decline in iPhone sales and first revenue drop in 13 years. And China was supposed to be a major growth engine for the company, but progress was slow, and revenue from China slumped 26% during the March quarter. And along the way, Apple was hit with a lot of other similar situations, where the share price took a major dive, due to investor confidence in the company being low. But here's a chart of Apple's revenues over the years. And here's a chart of Apple's net income, which is the money they keep after paying off all of their expenses. As you could see, even through all of the challenges Apple faced, they still continued to grow their business. They did have some years where the growth slowed down, but at the end of the day, the long-term trend went up. And that's exactly what the chart for the long-term share price shows. So to summarize, there's dozens of things that affect a company's share price, but at the end of the day, it comes down to supply and demand. It's important to realize that stock prices come from investors' expectations, and usually expectations for future profits. If investor expectations are too high, the stock price can become overvalued. But if investor expectations are too low, the stock can become undervalued, potentially creating a great buying opportunity for that stock. And this is a debate analysts have every single day around stocks. There could be 100 analysts giving their case on why they believe a stock is overvalued, while 100 other analysts are giving their case on why they believe that stock is undervalued. Every investor is unique and they understand businesses differently. For example, I don't really invest in pharmaceutical companies because I have a hard time understanding their business models. But I'll gladly invest in retail companies and technology companies because I'm able to understand the businesses, I could identify opportunities for the businesses, I could identify the threats, and if I have a good sense of what the profits for that company will be in the future, I could take my future financial forecast and compare it to today's stock price to determine whether I'm getting a good or bad deal on the stock, and whether the stock price is over or undervalued in my opinion. Now, the second way you can make money investing in the stock market is through dividends. And a dividend is basically a cash payout made from the company directly to your investing account. So some companies actually pay you cash every 3 months, which is known as quarterly, which is a quarter year, or annually, which is yearly. So they'll pay you cash directly to your investing account every 3 months or every year just to hold that company stock. You could take this money, spend it on whatever you like, or you could take this money and reinvest it back into the stock market. So there's two different types of investors. There's growth investors and there's dividend investors, also known as income investors. So growth investors are looking to invest their money and have that investment be worth a lot more in the future. Whereas dividend investors or income investors are looking to invest their money and to have those investments pay them an income every single month or every single few months. They could take these dividend payouts and spend it on whatever they like, a weekend with their friends, they could spend it on their bills, or they could take this money and reinvest it back into these dividend stocks, and when the next payout comes out, they'll be getting a bigger dividend. And then they could take that even bigger payout and reinvest it back into the dividend stock and have an even bigger payout next time. And if dividend investors do this long enough, in 15 to 20 years, you could be getting massive dividend payouts. So as we can see here, Walmart stock has a dividend yield of 1.67%. TD Bank has a dividend yield of 5.33%. And Pepsi stock has a dividend yield of 2.99%. So we're going to look at Pepsi stock as an example. So Pepsi stock has a 3% dividend yield, and the share price is $136.82. So 3% of $136.80 is $4.10. So we just found out that Pepsi stock will pay you $4.10 every single year for every single share that you own. So if you own 10 shares of Pepsi stock, the company Pepsi will deposit $41 directly into your investing account. If you own 100 shares of Pepsi stock, they'll deposit $410 into your investing account. And with that $410, you could go ahead and buy more Pepsi shares, and the next time the company pays out their dividends, you'll get a bigger dividend payout because you own more shares. As we can see here, 20 years ago, Pepsi stock only paid 37 cents for every single share that you owned. So if you bought Pepsi stock 20 years ago, you would have paid $37 a share. And not only would the share price have gone up drastically, by over 250%, but instead of getting 37 cents for every single share that you own, over time, Pepsi increased their dividend payouts, and investors started getting more and more money for every single share that they owned. Companies that pay dividends are companies that make large and consistent cash flows, and these companies usually don't have much growth ahead of them. So instead of reinvesting all of the money back into the business to grow, they feel that their shareholders, which would also include their own management team, would benefit more from getting cash payouts directly from the company, rather than taking this money and reinvesting back in the business. But it's also important to know that companies can stop paying their dividends at any time. They're not obligated to pay these dividends. This is just an added bonus to their shareholders. And this is also something that's important to understand when it comes to dividends. So as you can see here, Pepsi stock has an annual dividend, which is a yearly dividend of $4.09. So the dividend yield goes up and down based on what the share price is trading at the moment. So if Pepsi's share price was to go down to $100 per share, the dividend yield would go up to 4.09%, because $4.09 would be 4.09% of $100. If Pepsi's share price was to get cut in half to $68, then the dividend yield would go up to 6%, because the share price was cut in half, so the dividend yield would double. But no matter what the share price is trading at, Pepsi stock will be paying $4.09 for every share that you own, unless they announce that they're no longer paying this dividend, or unless they announce that they're increasing the dividend payout. As we all know, the global economy was basically shut down for a few months due to and this caused a lot of companies to stop paying their dividends because they needed all the cash they could get to have their business survive these hard times. So if we look at Carnival Cruise Line stock, we could see in January, when basically the entire global economy shut down, the stock price took a major dive because investors lost their confidence in this company. Carnival Corporation is a cruise line company, and all of their operations have been shut down for a few months. And investors were afraid that this company would go bankrupt. But as you can see here, because the share price took such a major dive, the dividend yield shows that it's 15.13%. A big mistake a lot of beginner investors would make would be to look at this 15% dividend yield and to be thinking that they would get a ton of money paid out to them by the company just for holding the stock. But on March 31st, it looks like Carnival Corporation suspended their dividends, meaning they would no longer be paying dividends out to investors. But on the other hand, there's also companies that have been paying and increasing their dividends for over 25 plus years. And here's a list of a few of them just as an example. Companies that have been paying their dividends for over 25 plus years are known as dividend aristocrats. And here's a list of companies that have been paying their dividends for over 50 plus years, and these companies are known as dividend kings. Before I invest in a company for their dividend, there's a checklist that I personally go through to see if that dividend is reliable and safe, and that there's a very low risk of that dividend being suspended. Dividend aristocrats and dividend kings are probably the best and most safe option for you as a beginner. Because they've been paying their dividends for over 25 plus years, there's a very low risk of them cutting their dividends. So there's two main ways you can make money in the stock market as a beginner. The first way is to buy low and sell high, and the second way is through dividends. But when buying low and selling high, there's three different investing strategies. The first one is day trading, the second one is swing trading, and the third one is long-term investing. Day trading is when you buy a stock today and you're looking to sell that same stock today for a profit. So if you look at Upwork stock as an example, we could see at 12:45 p.m. Upwork stock was trading at $16.31. So if I was to buy Upwork stock at 12:45 p.m. and if I was to sell the stock just 2 hours later, I would be making a 2% profit. But day traders are looking to do this multiple times a day, and their goal is to make a few percent profit every single day. Day traders might hold a stock for a few minutes or even a few seconds. Their only goal is to make a few percent profit and to get out of that stock. When day trading, you usually don't care about what the company does, and you follow what is called technical analysis. This is where you look at patterns in a company's stock chart and you look at data behind the company stock to try to determine where the company stock will be going in the next few seconds or next few minutes. Personally, I've never tried day trading, and I honestly never plan to. Day trading is the investing strategy that I've seen the least success in for other investors. But because it's such fast money, it really catches a lot of people's attention, and a lot of people start day trading. And majority of the stock market ads are going to be people trying to sell you courses on how to day trade. But if you decide to start day trading, I wish you the best of luck, and I'm just going to leave it at that. And swing trading is when you buy a stock and you're holding it for more than a day, but you're looking to sell that stock within a few weeks. And if you follow me on TikTok, you would have already known this, but I bought some shares of this company Nikola Corporation at around $26 a share, and just 2 weeks later the company stock went up 230%, and I was able to sell out of my investment at about a 180% return, meaning I nearly tripled my investment in less than a month. But as you can see, if I continued to hold on to this company stock, I would have lost out on majority of my stock gains. So swing trading is another short-term style of investing. But what makes this type of investing risky is that number one, with any investment there could be bad news that comes out around that company at any time. So even if good news after good news was coming out around a company causing investors to get excited, shortly after you buy into that stock there could be bad news that hits that company. And number two, a lot of the best swing trades come from company stocks that are really hyped up, that has a lot of investors talking about them. And when this happens, the stock can go shooting up to the point where that company stock is way overvalued. And if you happen to buy into that stock just before investors realize that this stock is way overvalued, that stock can come crashing down just as fast as it went shooting up. But if you know what you're doing and you can identify the right opportunities, then with swing trading you can make a lot of money. But even with that being said, my favorite investing strategy for advanced investors, intermediate investors, and especially beginner investors is long-term investing. Long-term investing is when you buy a stock and you plan to hold it for over a year. Now some investors may plan to hold a stock for 5 years, some investors may plan to hold it for 10 years, and some investors may just plan to hold a stock until retirement or to just pass it down to their children. Now there are investors that have seen success solely off of day trading and swing trading, but statistically and from what I've seen in my own personal experience, investors that invest for the long term are almost always able to get much bigger returns on investment on average when they look back after a few years. Very few investors find a short-term investing strategy that works consistently. In my personal opinion, I would stay far away from day trading, and although I have started swing trading a little bit more recently, 90% of my investments are in long-term investments. I have seen some pretty solid returns with my swing trades, but I'm more than confident I'll continue to see even better returns with my personal long-term investing strategy over the long term while taking much less risk at the same time. When swing trading, you're taking a lot more risk. It's also a lot more complex, and I don't recommend trying it until you have experience in the stock market and you have a full understanding of how the stock market works. And experience in the stock market is a major key when swing trading. But long-term investing is much less complex, and the sooner you start, the better. And I'll explain why shortly. But with long-term investing, there's also tax benefits. Now this will vary based on where you live and the income that you make, but generally speaking, I found that long-term investments are taxed at half the rate of short-term investments. For example, if I sell a stock within 12 months, I'd be taxed 30% on that profit. But on the other hand, if I buy a stock and sell it after 12 months, I'm only taxed about 15%. And over the long term, this makes a huge difference. There are tons of other benefits of long-term investing that I'll let you look into after this video, but just remember this: long-term investing is the most proven investing strategy, and it's the only investing strategy that the greatest investors out there, for example Warren Buffett, recommends to all investors. But even within long-term investing, there's different investing strategies that you could choose from, and it's up to you to decide which one is best for you. So I'm going to show you 2 investing strategies that I absolutely love. The first one can make you a lot of money, and it's very easy. Anybody can do this. It takes minimal effort, knowledge, and experience in the stock market. And the second investing strategy, which is the investing strategy that has gotten me some crazy returns, will take more effort and time to learn, but you could make a ridiculous amount of money over the long term if done correctly. So how to get rich in the stock market with little to no effort is through index fund investing. An index is a method to track the performance of some group of assets in a standard way. There's the S&P 500 index that tracks the performance of 500 large companies listed on American stock exchanges. Then there's the Nasdaq 100 index that tracks the performance of 100 large technology companies that are listed on American stock exchanges. The Dow Jones Industrial Average, or simply known as the Dow, is a stock market index that measures the performance of 30 large companies in America that are listed on an American stock exchange. And these indexes are often what investors are referring to when they say the stock market is rising or the stock market is falling today. Because although they don't track the performance of every single stock in the stock market, these 3 indexes are the indexes that track the companies that have the most wealth invested into them on American stock exchanges. Every country with a stock exchange will most likely have a stock market index that tracks its performance. So here's a 40-year chart of the S&P 500 index. The S&P 500 is a stock market index that measures the stock performance of 500 large companies listed on stock exchanges in the United States. Here's a list of the top 20 companies included in the S&P 500, and all 500 companies make up about 75% of the total US stock market. As you can see, over the last 40 years, the S&P 500 has consistently gone up, with the exception of some stock market crashes. As you can see here, a stock market crash is a sudden but dramatic drop in stock prices across the entire stock market. So basically, when something really bad happens to the economy, and when investors are afraid that the economy will start slowing down rather than growing, or when company valuations, which is their market caps, become way too high to the point where they don't make sense anymore, many investors begin to start selling their shares at the same time. And investors panicking in the markets usually makes these stock market crashes way worse than they need to be. Because once people realize everyone else is selling their shares, they're going to want to sell their shares as well. And it becomes a big snowball effect where more and more investors begin selling their shares. But over the last 150 years, when the economy or stock market crashes, it always comes back stronger. And this is why, while most investors fear stock market crashes, experienced investors understand that these are great buying opportunities. The most famous stock market quote ever is by Warren Buffett. And he says, be fearful when others are greedy, and be greedy when others are fearful. And when he says this, he's basically saying when stock prices are high, be fearful. But when the stock market crashes and stock prices are low, that's when you want to be greedy and buy up as many shares as you can. Because he understands over the long term, when the US economy or the US stock market crashes, they always come back stronger. And when the stock market crashes, you'll be able to buy some great company shares for a very, very big discount. And here are some stock market crashes that I suggest you look into to better understand how stock market crashes work. But even through all of these stock market crashes, over the last 90 years, the S&P 500 has returned an average of 9.8% to investors every single year. 9.8% on average is an amazing return. The average yearly return for housing increased by 3.7% between 1928 and 2013, while stocks returned 9.5% yearly during the same time. So while real estate returned just under 4%, the stock market returned about double the amount to investors during the same time. Now, this doesn't include rental income, this just includes property value. But then again, you don't need nearly as much money to get started investing in the stock market, and you could sell out of your investment much more easily if you ever needed the money. So how this works is you're going to consistently invest as much as you could afford to into an S&P 500 index fund. And even Warren Buffett, one of the most successful investors of all time, says that this is what most investors should do. By investing in the S&P 500 index fund, you're basically investing in the top 500 companies in America, and you're managing your risk by spreading it across 500 different companies, rather than just making a few investments that could succeed or fail. And how this is going to make you a lot of money is if you invest consistently for the long term and take advantage of compound interest. Albert Einstein says compound interest is the most powerful force in the universe, and I'm going to show you why. So we're going to use a compound interest calculator to find out how much our investments would be worth with compound interest over the years. And the amounts of money I'm going to use is just an example. Some people can afford to invest more and some people can afford to invest less. But you could go ahead and put in your numbers into this compound interest calculator if you'd like, just by googling compound interest calculator. But regardless of how much money you invest, if you invest consistently and let it compound over the years, you're going to make a ridiculous amount of money. So we're going to say that you have $500 to invest. So you make an initial investment of $500 into the S&P 500. And every 2 weeks when you get paid, you invest another $300. And we're going to use an interest rate of 9.8% because that's the average return the S&P 500 has given to investors over the last 90 years. So we're going to assume that the next 30 years will be similar. And we're going to have the interest compounded yearly because it returned an average of 9.8% every year. So if we do this for 30 years, your investment in the S&P 500 would be
$1.3 million.
So like I said before, the numbers will vary based on how much you're willing to invest, but assuming you invest $500 today and you invest $300 every single 2 weeks, in 30 years you would have only invested $234,000 to have your investment be worth $1.3 million. And just keep in mind, this requires zero skill whatsoever. You're not following the news for any companies, you don't care if the stock market goes up, and you don't care if the stock market goes down. All that you're doing is you're consistently investing every 2 weeks into an S&P 500 index fund to try to match its average yearly return of 9.8%. And if you do this over the long term, the powerful force of compound interest will make the value of your investments grow exponentially. So before I show you the investing strategy that I use and how you could potentially make way more money in the stock market, I'm going to quickly show you how compound interest works for those of you who are still confused. I'm going to show you what happens to a penny when you double it every single day for 30 days. So in the first day you have 1 penny. In the second day you have 2 pennies. In the third day you have 4 pennies. By the 10th day you have $10. By the 20th day you have $5,000. And by day 30 your 1 penny that was multiplied every single day for 30 days is now worth $5 million. So compound interest when investing is when your investment multiplies on top of your investment. But with the S&P 500, your investment would be multiplying by about 9.8% on average every single year, instead of being doubled or being multiplied by 100% every single day like that penny example. But as you can see here, it does take some time, but by year 20, the value of your investments begins to explode. So like I said before, index fund investing requires little to no work. All you're doing is you're investing consistently into an S&P 500 index fund and you're forgetting about it. And you can make some really great money over the long term. So if you guys want a step-by-step video on how to invest in the S&P 500 index, let me know in the comment section or message me on Instagram at AbuTheInvestor and I'll gladly respond or make a video for you guys. But now we're going to talk about the investing strategy that I use that has allowed my returns to way outperform the S&P 500 index. Now I'm still a long-term investor, but instead of investing in an index fund, I invest in individual companies or individual stocks. And this is called stock picking. And if you're a successful stock picker, you can make a crazy amount of money over the long term. And there's countless examples that I could give you, but just as a few that you may be familiar with, if you invested in Apple stock, Amazon stock, Facebook, Tesla stock, or Microsoft stock just 5 to 15 years ago, the value of your investments would be up more than 5 times, 10 times, or even 15 times more here today. But just as an example for my personal investments, about 15 months ago I started purchasing shares of Tesla stock, and the average price that I paid for my shares was $239 per share. But here today, those same shares are worth $1,500. So I sold a few Tesla shares because I didn't want all of my eggs in one basket, but the Tesla shares that I do still hold are worth 529% more than what I paid for them. And I'd be taking a $6,300 profit if I decided to sell my shares here today. But that's just one of my investments. And let's be honest, $6,000 or $7,000 isn't really a lot of money, especially when you have 7-figure goals like myself. But how you can make a lot of money in the stock market by stock picking is if you're able to see success consistently, and if you're able to reinvest your profits back into the stock market to take advantage of compounding. And over the years, you can make a crazy amount of money. So between all of my investments in this particular investment account, I'm currently up 122% on my investments, or $7,300 US. And that's with me cashing out some profits for personal use. But what's more important is my average yearly return. So I started investing just under 3 years ago. And since then, I've managed to receive a 58% return on my investments every single year. A 58% return on average every year is amazing. But for me to maintain that return for a 20+ year span would be extremely unlikely. There will be moments in the next 20 years that the economy or the stock market isn't as strong. And although it wouldn't be impossible, but it'll be harder to find those high growth stocks. And with an investment like an S&P 500 index fund, you're investing in 500 different companies. So if one company's stock fails, it doesn't make a big impact on your investment. But if you're investing in 5 or 10 individual stocks, for example, if one of those investments fails, it would make a much bigger impact on your account's overall value. And although I did have one investment that failed pretty bad, the rest of my investments were successful enough to make up for it. And like I showed you, my average yearly return as of today is 58% every single year. So to show you how much money there is in being a successful stock picker that invests for the long term, we're going to pull out the compound calculator once more. And we're going to use the exact same numbers that we used in our last example. But this time we're going to assume we're a successful stock picker, and instead of putting in my 58% average yearly return, we're going to assume that over the next 30 years, we're skilled enough in picking the right companies to invest in to get a 15% return every single year on average for the next 30 years. And with the same exact amount of money in the first example that got us $1.3 million, a 15% average return on investment every single year, instead of a 9.8% return, would give us over $3.6 million instead of $1.8 million. And with the same amount of money invested, at a 20% return every year, your investment in 30 years would be worth over $10 million. And remember, that's only investing $300 a paycheck, and in 30 years, you're turning $254,000 into $10 million in 30 years. So clearly with stock picking, there's a lot of money to be made over the long term. And some of the most successful investors like Warren Buffett or Peter Lynch, who average a 29% average annual return over 22 years, use what is called fundamental analysis. Fundamental analysis is when you're looking at the fundamentals of a company. You're looking at things like the company's brand and the company's strengths and weaknesses. And you're also looking at the financials of that company, meaning their balance sheet, income statement, and cash flow statements. And with fundamental analysis, you're also looking at the industry. And you're looking at things like how big the industry is for that company and how much potential growth there is for it in the future. You're also taking economic conditions into consideration. But most importantly, you're looking at the future profit outlook for that company. And by taking everything into consideration, you're putting all of the pieces of the puzzle together to figure out how much profit you believe this company will make in the future. And then the final step of the puzzle is to see if you're getting a good deal on the company stock. So you take all of the information you gathered and you compare it to the market cap of the company to determine if you're paying too much for the company stock based on your future financial outlooks, or if you're getting a good deal on the company stock based on what you believe this company can accomplish over the next few years. But unfortunately, majority of investors that try stock picking ultimately fail over the long term, and they're not able to beat the S&P 500's average return. So this is why investors like Warren Buffett and even myself recommends that most investors just stick to investing in the S&P 500 index fund. But if you believe you have what it takes, like I believe I have what it takes to be a successful stock picker over the long term, then I would suggest focusing on learning fundamental analysis, studying the strategies of great stock pickers that came before you, for example Warren Buffett and Peter Lynch, and a must-read book is The Intelligent Investor. But honestly, in my opinion, stock picking isn't as complicated as people make it seem to be. And I believe with enough dedication and time, it's something that everybody can learn to be successful at. But if you're interested on a video on my personal investing strategy and how I personally pick stocks, or if you'd like me to make a video breaking down all of the companies I invest in, go ahead and let me know in the comment section and I'll gladly make that video for you guys. But I'd just like to say, if you watched the video till this point, thank you so much for your support, and I really hope you learned a lot from this video. If you'd like me to make a video breaking down all of the companies I invest in, I just ask that you hit the like button and leave me a comment in the comment section, as it really does help my channel grow. And again, if you have any questions, you can message me at Abu the Investor, or you can leave a question in the comment section and I'll gladly answer those questions for you guys. But I really look forward to seeing you guys in my next video. Thank you so much for your support and have yourself a great day.